sponsorizado por FX for a Living. Nos va a hablar de estrategias con las que ha ganado esos campeonatos mundiales. Bueno, enhorabuena y adelante. Estamos expectantes, Rob.
Morning. Thank you very much. Great to be here in Madrid. Well, thank you. So let's go ahead and let's get started because I have a lot to cover, and I just want to make sure, is the translation going through okay for you? Yeah, good, wonderful, thank you. So before we get started with the fun stuff, I like to just remind everybody that trading involves risk, not just reward. It's great when we talk about how much money we make, but we also have to focus on how much we lose. And so make sure you consult a registered financial representative before ever doing, so a professional, before ever doing any trading, okay? With that being said, I was fortunate just 2 weeks ago to win a couple more competitions over in Italy. And many of the competitions that I won over the last few years, and even a competition I was performing very well early in the competition yesterday. I went ahead and was using the strategy I'm going to teach you this morning. So normally, it's my understanding that people talk about general theory and psychology of trading at some of these presentations, but if it's okay with you, I'd like to teach you an actual trading strategy and setup today. Is that okay? Great. So before we get into that then, this is my website, becomeabettertrader.com. And those of you that are online today, if you want to fill out this little area, first name, email, we'll invite you to a special day in my live trading room for those of you that are out there on the internet. This is the real reason why we're here. As they mentioned, won a lot of competitions around the world. The ones in blue are international, and the ones in black are domestic. So pretty exciting, and real money. It's not just talking about trading, it's doing it. That's what makes it special. That's what makes it fun. So what we're going to talk about today, you're in the right place if you trade stocks, options, futures, or of course, Forex. If you're a day or a swing trader, this also applies to you. If you're a long-term investor only, this particular strategy is not for you. But if you trade for a few minutes to a few months, these particular strategies will apply to you. Okay? So, real quickly, before we get going, if you guys want to real quietly fill this form out, just your name and email address, we're going to do a drawing right here in a little bit for 5 of these courses in a day, and also days in my live trade room for everybody who fills this out. So that's why your email address is important. And we'll pass those in at the end. Okay, so that'll be fun because today I get 45 minutes with you. So this course, though, I spend hours teaching it. So this is the actual full course that you guys, 5 of you, will win. Now, this strategy, the reason why it's important to me, this is called my stochastic spike strategy. And I used this to help me win in Turin in Rimini, Italy, just 2 weeks ago. In fact, here are some of the actual trading areas that I was taking these trades that I'm going to teach you over the next several minutes. And yesterday, I was actually trading the DAX during the trading competition. And early on, I was performing very well, several hundred euros. And this strategy was the strategy I was using. So this strategy helped me make the most money yesterday, okay? These trading competitions can be very intense. My friend and wonderful trading champion, Tariq, there's myself, many other traders from around the world. And then over here, you can't see him, but Davide Biocchi, who was in the event yesterday. Wonderful trading colleagues and champions, some of the best in the world to trade against. So I'm very proud to be on that stage against such powerful traders, okay? So let's talk about this strategy, and all of you are welcome to take a picture of this. I think this is being recorded for you as well, I hope. I believe this is being recorded so you can watch it later. Yes? Okay. All right. Good. Wonderful. So, but you're welcome to take a picture if you want it like right now, so you can go home this afternoon and look at your charts and work with this strategy, or this afternoon. And in fact, I'm going to be here all day. So after this event this morning, I'm going to stay here, and then I'll come back for a discussion at 3 p.m., I believe it is, this afternoon as well. But I'll stay here all day and answer your questions outside in the hallway here, okay? So anybody who has their computer, wants to look at the strategy, happy to help you while I'm here. I'm going to stay here all day for you, okay? So let's talk about the strategy. What is it? It's a wide-range stochastic spike against the predominant trend. So when do I use it? In trending environments. This is different than how most people use stochastics. Most people traditionally in books, they look at a flat market, and if it's overbought, they sell when it comes down, and when it's oversold, they buy when it starts to go back up. I like to actually use it in a trending environment. Now here's the traditional stochastic setting that I'd like for all of you to focus on today. 14.3.3, that's for general trading applications. You might want to write that down. So let's take a look at this. Now, everybody here has different trading platforms, but typically it'll either, in most of your platforms, either come up as stochastic or fast stochastic. You'll know you have the right one because it will actually give you 3 inputs. It might say like 14.1.3 or something like that, 14.1.1. You'll change it to 14.3.3. If you open up your stochastic and it only gives you 2 choices, that's the wrong one, okay? So look for the one that gives you 3 choices because we want 14.3.3, all right? Now, where's my entry? It's at the close of a spike bar where in an uptrend, so in an uptrend, we start from above the 80 and fall below the 20 level, or in a downtrend, start from below the 20 level on the stochastic and spike up above the 80. Of course, I'm going to show you lots of examples of this in just a few minutes. My stop loss, the trade's past a preset stop loss number or a key support resistance level like the 20-period exponential moving average. So the reason why this may vary is because some of your trades will actually be taken past the 20 EMA, as I'm going to show you in just a few minutes, especially if you use the default setting of 14.3.3. So the key important thing is know your stop loss before you get in the trade. How many of you have ever put on a trade and then decided, I'm not sure where I want my stop, I'll let it go, I'll let it go, I'll let it go, and then all of a sudden, what could have been a small loss becomes a big loss. Anybody ever do that, or am I the only one? Yeah, thank you for your honesty. So, with that being said, let's take a look at this. So, what I want is my stochastic, that's this blue line down here. Don't worry about any of this. All we want to focus on is that black 20-period exponential moving average and that stochastic that I was just showing you. So, what I'm looking for in a downtrend, and that's basically how I qualify a downtrend, is I like to look back over the last 20 periods. If I'm a day trader, might be looking at a 2-minute, 5-minute, 1-minute chart. If I'm a swing trader, especially, of course, in Forex, looking at daily and weekly charts. So, looking back over the last 20 periods, I'm looking for that 20-period moving average to be in a downtrend, okay? Now, if I'm in a downtrend, then I'm looking for us to start below the 20 level. That's this lower black line right here. This is the 80 level up here. So I want to start below the 20 level, spike up above the 80 level, and that's where I want to short, okay? Right at the close of that bar, In fact, what I tend to do, I like to take the trade right before the period closes so that I'm in the trade before the black box systems, the algo programs, initiate their trades, where the robots detect this and then they trade. So I get in right before the close of the bar, okay? Now, here's another example, okay? So the market's going down. We start below the 20 level. We spike up above the 80 level. The stop loss, we're looking to have the stop loss right back a close beyond the 20-period exponential moving average, okay? But if the distance is too far, okay, if the distance is too far, like in this case, this was roughly $30 plus almost $40 of difference because it's a weekly chart. So this is a lot of distance. That's where you might have a preset stop loss limit. Say, well, I'm not willing to lose $40 per share of a stock. Or perhaps 40 pips on a trade. So I'm going to limit my orders to 10 pips, $10, whatever instrument you trade. So it's about risk management. But of course, the closer you can take the trade to the 20-period exponential moving average, maximizes your reward, but reduces your risk, okay? So let's go ahead and talk about profit exits. This is typically a trailing stop or past a preset or a next support resistance level. So let's talk about this. I want to have you think about 50, 80, 90 price. 50, 80, 90 price. So what we do, and this is Japanese yen FX trade, and so the entry was taken here, where this yellow line is. And can you see okay over here? You guys good? Am I blocking you too much? I'll try to move around. Great. This is where the entry is taken. Now, my target was up here. Typically, what do I use for targets? I like daily, weekly, and monthly pivot points. Many of your trading platforms will either call them pivot points or they'll call them floor trader pivots. I'm looking for the classic ones. There's a lot of new pivots these days where people change the formula a little bit, put their name on it, and sell it for a lot of money, okay? I'm talking about the free classic pivots, all right? So that's one of the key support resistance levels I use, or like the 50 or 200-day moving averages. Whichever one comes closest to the trade that I'm taking, okay? Whichever one's closest, that's going to be my initial target. I may hope it goes much higher, but hope is not going to be what makes me profitable for the long term. Analysis is, okay? So what we do, this is the entry. This is the target up over here. This is the next pivot point, right up here. That equals, right here, equals about this area here. So this is the entry. This was about 50% of the way to the target. So remember I said, think 50, 80, 90 price. Okay, so when we get about 50% of the way to the target, then I want to go ahead and start trailing up, and that's what this is, the trailing profit. I trail up about 50% of the total profit earned so far. So in real terms, what that means, if the market pulls back and takes me out of the trade, I still lock in 25% of the overall move to my target. Make sense? Okay? What I'm looking to do here, is early on, I'm trying to give it a little bit more room to still run to my target, but if it's going to pull back, I don't want it to turn around from a profit and become a loss. How many of you in this room have ever taken a trade and you said, I want just a little more money on this trade, and then it turns around and reverses and you took a winning trade into a losing trade? Anybody here, or am I the only one? Okay, yeah, thank you. So this is the method that I'm using. This is something I learned many years ago, where I actually had a profit on the board with a huge position, but I wanted about $8,000 more on the profit. So I wanted a little more profit. So what happened was I said, I'm going to stay in the position. During this big position I had open, the Fed came out, made a Federal Reserve in the United States, made an announcement, and whoosh goes the market. And I didn't have this trailing stop. So I took this wonderful profit and turned it into a loss, okay? So many years ago, that was a great learning opportunity for me. And after I changed this, after I started doing this, I started winning all those competitions around the world. So that's kind of a big deal. Make sense? So So we start off initially with target entry, 50% of the way to the target, we're trailing by 50% of profit earned. Now, as we get closer to the target, now I start trailing by 80% of the profit earned. Why? The reason why is because wouldn't it be terrible to have it get so close to my profit and then come all the way back down here? And what's more likely, the longer the market's been moving, look at this here. Look at how the market was going up, up, up. The longer it goes up, the more likely it is to reverse, isn't it? So the more aggressive I want to be as I get closer to my target. Does that make sense to everybody? Great, wonderful. So now, we started at 50%. Now, as we're getting 80% of the way to the target, we're trailing up by 80% of profit earned, okay? Then, as we get to the target, now I'm trailing up by 90%. Why? Because what I'm doing is I'm giving this a chance to go a little bit further. Many of us, when we first start trading, what's one of the first trades we learn because it's easy? The breakout trade. Oh, it breaks yesterday's high, breaks yesterday's low. It seems very easy to me. I'll make millions of dollars that way. But the reality is that what happens for most of us, we get into that trade right after it breaks the high or the low, and then it turns around and goes against us, okay? So what happens is I do allow for a little bit of room to go a little bit higher to trap retail traders in the position, okay? So I'm willing to give it a little bit of room if it wants to be that exceptional trade that it goes a little bit further. But at that point, if it doesn't, if it stops, hits the target, and pulls back at all, I'm out. Does that make sense? So think 50, 80, 90 to price. Because if it doesn't whoosh through that level there, then what I want to do is basically move it right up to price. The next pip, the next tick, the next cent, euro, I want to be out, okay? So let's review that one more time. Okay, think 50, 80, 90 price. Start off initially with a 50% trail. Then as we get 80% of the way to the target, move it up to 80% of profit earned. Then as we get to the target, we move it up to 90% of profit earned. And then if it doesn't break through, we just put it right to the price and then out. Does that make sense? I'm giving it a chance to make money, but if it's going to stop and reverse, I don't want it to take all my money and worse, turn into a loss. Okay? So, let's talk about a couple points to remember. I'll make sure I stay on time today. A couple things to remember. You want to know your exit, scale out, and stop out points in advance. In other words, have the trade planned before you enter. We never get smarter once we're in the trade, because at that point, fear and greed take over. We always want more money. If once we're in the trade and we see profits on the board, we want more profits. We see a loss, we don't want to take the loss, so we look the other way and hope it will come back our way. Okay? So we need to know exactly what we're going to do when we're most likely to be objective and be honest with the performance of the potential trade. Okay? Next thing to know, using the strategy, the best trades start in the uptrend where we start above the 80 level on the stochastic and fall down below the 20. That's in an uptrend. In a downtrend, the best trades start from below the 20 level and spike up above the 80 level. So a big overextension within a trend. That's what we're looking for, okay? And then watch and use in the direction of the 20-period exponential moving average. Now, if your favorite moving average is a 19-period or a 21-period, simple or exponential, it's okay. Somewhere around 20-period exponential, that's what I use. Okay? All right. Now, let's look at an example here. All right, so this is a trade that I took over in London at the World Money Show. So what happened here, this black line, that's the 20-period moving average. Would you say that's a downtrend? Sure, right? That's a downtrend, okay? Now, so what am I looking for in a downtrend? What's the optimal trade? What's the best trade? I want it to start from below the 20 level, and I want to spike up above the 80 level, okay? So if you notice here, we started below the 20, spike up above the 80. I went in and took that trade right there live. It was supposed to be a trading competition, but the person I was supposed to trade against didn't come, so I just said, well, like here, I'm with this big audience, I'm just going to trade anyways. So this was an actual trade that I went in and took at the Money Show there in London. And so I went ahead and took the entry short right at the close of the bar. Okay, stop loss back behind the 20-period moving average, and it whooshed to the downside. Okay. In Barcelona, I was here a few years ago in Barcelona. I just got done teaching this class. It was actually for a broker firm, trade station, and it was at the university. And I just got done teaching this strategy. And take a look here. What do you see? Is that a downtrend? It's a pretty good downtrend, isn't it? Okay, so what am I looking for in a downtrend? In a downtrend, I'm looking to start below the 20 level and spike up above the 80 level. Okay? Does that make sense? It's really important that you know, these are the types of trades we love to look for, okay? We love to look for these types of trades because what this is, all right, so here's how this happens for most of us when we're first starting to trade. We go ahead and we don't take the trade here because we don't believe it's going to keep going down. We don't take the trade here because we think, oh, now it's going to reverse for sure. Then all of a sudden we see it whoosh to the downside. We're like, oh no, I'm missing all this profit. I got to get into the trade, right? So we take the trade and then it spikes up against us. We take a stop loss and then we watch it go right back the way we thought it was going to go. Anybody ever feel like every time you get into a trade, it goes against you? Anybody ever feel that way? Yeah. So what happens is a lot of times it's because our timing of the entry is off. We had the right idea, but we waited too long because we were afraid this one might be a loss. How will I handle the loss? And by the way, there's still, for those of you that are standing back there, I think there's still a few chairs over here if you guys want to sit down. But thanks for all of you that are standing in the back. So what we want to do is we want to take this trade right here at the close of the bar, okay? And again, I actually have a clock on my computer. This is not my computer. If it was, you'd see a clock. That's why I keep checking my watch to make sure I'm respectful of staying on time for you guys today. But I have a clock because what I'm doing is I'm watching. So like if I'm trading intraday, I'm looking at a 2-minute bar. I'm looking at a 5-minute bar. What happens is right when that bar is about to close, about a couple seconds before that bar closes, I enter the trade. And again, the reason why I do that is because there's several black box systems, algorithmic programs that will detect this type of pattern, and I want to be into the trade before they're in the trade, so when I get in here and then their black box systems can whoosh the market in my direction once I'm in the trade. Make sense? So that's why I try to get in a few moments. And so on a daily chart, that would be right before the close of the day. On a weekly chart, it'd be right before the close of Friday. Okay? All right, so and again, the stop loss officially is back behind the 20-period moving average unless it's too far away, and at which point you use a predetermined stop loss number. We trail the profits to the next key support or resistance level, and the best trades in a downtrend start below 20 and spike up above 80. Okay? just the opposite in a downtrend. By the way, don't forget to fill out these cards. Those of you that are standing in the back, I'm sorry, you probably won't have one, but you can go to becomeabettertrader.com, just enter your email address. I'll still invite you to a free day in my trading room to watch me trade with these strategies. But we're going to collect these in a few minutes, and I'm going to give away 5 of these just as a reminder. So we'll just quietly fill those out, and we'll pass those in, and then I believe one of the ladies will collect those. Now, let's look at more examples of this. This is a great example of this in action. So what we have here, you'll notice we have the uptrend, okay? So we have the uptrend, but notice where the entry for this trade is taken. The entry for this trade is taken below the speed line. That's because with the classic setting here of 14.33, often you will actually take the initial entry when it's already past the 20-period exponential moving average. That's why I said for your stop loss, there's 2 things. If you're taking the trade in front of the 20-period exponential moving average, then you can use behind the 20-period exponential moving average as your stop loss, okay? But if you're taking the trade already beyond the 20-period exponential moving average, then you have to have a clear-cut number of pips, ticks, euros that you're willing to lose on the trade before you take the trade, okay? So notice with the classic setting here, we have an uptrend. We start from above the 80 level, and we spike down to or below the 20 level, in this case, to the 20 level. Now, the trade can be taken right at the close of this bar, or you can go ahead and wait till the fast stochastic pushes through the slower stochastic, and we push back above the 20. This entry is more conservative. It's more conservative. You're validating that it's likely to continue to reverse back the opposite way. Okay, so for those of you that are more conservative-minded, or perhaps have had a lot of losses in the past in your trading, and so risk makes you nervous, this might be a better way to do it. Wait till it gets back above the 20-period exponential moving average, and the fast stochastic turns above the slow stochastic, okay? Now, of course, the downside of that is you're giving up some of your profit. Instead of taking the trade here, like I might look to take the trade, you're taking the trade up above the 20-period moving average, so you're giving up some of your profit. But again, from a risk-reward perspective, for those of you that have been struggling in your trading, that's not a bad thing to feel a little more confident in your trade, is it? Okay? So let's look at some more examples. All right, so we have a rising trend. We're looking to go ahead and take the trade in an uptrend when we start from above the 80 level, pull back down to or below the 20 level, and then again, I'll either look to take the trade right here for myself, where I'm feeling more confident, or for a small lot retail trader, we can go ahead and focus on taking the trade long back above the 20-period exponential moving average, and when the stochastic crosses above, the fast stochastic crosses above the slow stochastic. Then you see a nice whoosh up here, pulls back, and then can I take another trade if this has already happened? The answer is yes, as long as I've gone ahead and already, I still have an uptrend in place. If the market has started to flatten here, then that's a problem. If the market is going flat, again, that's the traditional way people teach you in books. The problem is that the traditional way in a sideways market works great for a little bit. It's kind of like counter trend trading. We tend to make a little, make a little, make a little, and then when that one trade goes against us, we lose a lot. Okay? So the classic way taught in books, I don't prefer. I just like to use this modified where I'm only looking for long side trades in an uptrend, or only looking for short side trades if we're in a downtrend. Okay? Now, is this making sense? I'm not sure if there's going to be a microphone for questions, but I want to make sure that we're making sense here. I'm going to show you some more examples, but I don't know if there's a microphone, but if anybody speaks a little English and has a question, I'll be sure to answer it for you in a few minutes. Okay, so here's another example as well. So this is the euro and the FX, and so it's the same concept. By the way, how many of you trade Forex here? Okay, all right, stocks. Okay, I thought so. I met a lot of people that traded stocks yesterday. Options. How many trade options? Okay, some. And futures. How many of you trade futures? Okay, all right, fair number of you. So, so even it's our special Forex day today, but you see a lot of you trade many things. So this is an important strategy that you can use in multiple markets. Okay, now, so what are we looking for here? This kind of thing here. Too shallow. Yes, it worked. That's wonderful, but that's not what we're looking for with this strategy. What I'm looking for, because this kind of thing here where it pulls back a little bit, I see all too often where it'll pull back deeper and deeper. It's much better, in my opinion, to take these trades where we have a trend in place, and that's why I made this very simple chart here. Just a 20-period exponential moving average, and then the 14.33 stochastic. Okay, so you could start with that. And again, just as a reminder, for all of you that are here live today, I'll stay here afterwards and be happy to answer questions. And if you brought your computers, I'll look at them with you. And I believe I have a panel discussion this afternoon as well with another trading champion, Tariq, at about 3 o'clock or so. So I can see you there as well. All right. So, another example of this. Okay, just trying to really show you a lot of examples to help make this make sense for you. We have an uptrend in place. We pull back, but I don't want to take the trade right when it pulls back to here. Stochastic is still coming down. I'd like to see the stochastic get down to or through the 20-period exponential moving average in that uptrend. That's where I'm looking to take the trade. And again, a real important reminder. When you're starting to practice with this trade, first of all, of course, always start on a simulator before you ever spend real money. Then before you move to real money, make sure you understand the difference between taking the trade where it's still coming down, but we've pulled back below the 20 level, or the more conservative way of waiting until it pulls back above the 20 level, and the fast stochastic is going above. You see the very important difference. Me, here, I have more profit opportunity, but I have more risk as well. So for those of you that are new, you might want to consider waiting until it gets back above the 20-period moving average with the stochastic. And again, if you use something besides a 20-period exponential moving average, as long as it's somewhere around 19 to 21 bars, simple, exponential, that's good, okay? All right, so here's another example. So we have a nice uptrend in place, all right? Market's pulling back. We start from above the 80 level and fall down below the 20. And you can see here, gang, this doesn't matter whether we're talking about a 2-minute chart, a 5-minute chart, a daily chart, a weekly chart. In fact, let's go back and look at these, do these different things. And by the way, we'll collect those cards here in just a few moments. I think David's going to have somebody come in, or I may use, since you came to my class yesterday, I might get your help and have you just, they'll pass everything into the aisles, and then maybe you could help me collect them if that's okay. Thank you. Appreciate that. So this is the Russell, the U.S. Russell. This is a 2-minute chart. This is also the Russell, a 5-minute chart. This is the Euro daily chart, okay? So it doesn't matter what we're talking about. This here is the British pound, and this is a daily chart, okay? So my challenge to all of you is to go ahead and look at this afternoon. Hopefully some of you can do it on your phone, your computer. At least by tonight, go home and take a look at this setup. And for those of you that are here today, happy to look at it with you because I love this. And yesterday, I within the first hour of the trading competition, I was grossing approximately 450, 500 euros within the hour, doing small lot positions. and the money I was making was on the DAX, and the market was just pulling back, pull back, and I'd go long, and it's push up again, pull back, push up. And I even said that during the event. I said, hey, I'm taking pullback trades. It's one of my more favorite trades. Why? Because as many of you have found out the hard way, sometimes we wait to get into a trade, and the market's going up, and they're like, oh, it's going up. I don't want to miss any more. So we jump into the trade. It pushes back, stops us out of the position, only to go back up. And we're like, I knew that was going to happen. And yet somehow you still lost money. Okay? And so what I'm trying to do today is take some of that pressure off, avoid the area where you historically would get stopped out of the trade, and then look to enter after that reversal. Does that make sense to everybody? Maybe just raise your hands and let me know. Does that make sense? Okay, all right. So like I said, we looked at the euro, pound, we looked at U.S. stock indices, same thing. This is crude oil. That's another favorite of mine that I like to trade. Didn't trade it in yesterday's competition, but I do try it in Turin and Rimini, Italy. I focused on crude oil. I think I did trades in those both days, if I recall correctly. So crude oil is another fun one. And so this is the same thing. This is crude oil on a daily chart, okay? So you can see here, we start above the 80, we pull down below the 20. The entry is when we go down below the 20, if you're being like me, more aggressive, or you're professional, or you're confident in your trading. If you're coming from a position where you haven't been doing very well in your trading, again, I encourage you to modify it slightly to increase your performance from a risk perspective, but you'll give up a little bit of the profit. But is that okay? Is it okay to give up a little bit of profit and be a little bit more right on the trade? What do you think? Is that okay? Yeah, I think that's okay. Because over time, you'll become more confident, and then you can be a little bit more aggressive. But show that you can make money first, okay? Kind of like this presentation or the conference here. What is it? FX for a living, right? Show you can make some money first before you get aggressive. So here's some more trades. These are actual trades I take in my live trading room. And again, all of you that filled out that little form, I'll collect those. If you got your email address, I'll invite you probably next week to come to my live trading room for a day. Those of you that are online today, just a reminder, you go to becomeabettertrader.com. Happy to come have you for a day so you can watch me take these trades. So what we have is this black line. That's the 20-period exponential moving average. And again, this is the beauty of this particular trade. I can, initially teach it to you in 45 minutes and go ahead and at the same time, have you just focus on a 20-period exponential moving average and a stochastic. If you've got lots of other trend tools and cool tools, robots, things like that, wonderful. But this trade can be taken by itself, as you saw, very plain, okay? So this is a trade I took in my live trading room. You can see here, we started below the 80 level, or the 20 level, excuse me, spiked up to the 20 level. I went short. It rolled over, okay? These trades here happened after the trading room, so I didn't do those in the trading room. In the trading room, I trade live right in front of people on the screen, just kind of like the trading competition yesterday. Here's another example of this as well. Oh, are you here to collect the cards? I'm not sure. I'm not sure if she's going to collect. What's that? 5 minutes? Okay, great. So let's do this. Maybe I'll get your help because I don't see David's assistant. Could you maybe just collect the cards? I think they're going to pass them to the corner. If you just collect them for me, because I want to draw 5 names to send you guys home with these. Well, the ones I didn't drop. So here's another trade that I went ahead and I took. And so what we have, you have your 20-period exponential moving average in the downtrend, okay? All right, and we'll try to keep it a little bit quieter because I'm still teaching. I've got some important stuff I want to share with you still, okay? So what we have here is we have the 20-period exponential moving average, and then you see we came from below the 20 level, spike up above the 80 level, and that's where I went short. I really like this kind of trade too. Why? Because like in this case here, what happened is a big whoosh to the upside. I love that because usually that's where the average retail trader is losing money, okay? So I like to get in after I see all of them get out, right? Think about your own trading for a moment. So if you think about your own trading, what happens is, how many times have you been in a position where it's losing money, but it's only losing a little bit of money? So it's like, okay, whatever, 25 euros, 50 euros, 100 euros, okay, but then all of a sudden it goes whoosh against you, and now all of a sudden it's like down 300, 400, 500 euros, you're like, whoa, and so you get out of the trade, you panic out of the trade, right? But when it was going slowly against you, you're slowly losing money, you kind of like, well, okay, it's only a little bit of money. Maybe it's gonna come back, and you hope that it's gonna come back. Oh, yeah. So in the middle here, could you guys pass them to the edge, please? Just pass them to the edge. Thank you. So that's why you're probably getting missed. So so what happens is when down here, people see this big move down, and then they say, oh, I've probably missed it. But then, and think about how many times this has happened to you. You're like, oh, I've missed the move. I was away. I was on the telephone. I was at work. I missed the move. So then it keeps going, and it's like, oh, maybe I should get into the trade. Oh, geez, I wish I would have gotten it up here like I wanted it. And then finally it starts having a little bit of feverish activity, especially like in the Forex. We see it all the time, okay? You see it in stocks though, you see it in futures, I see it in Forex, where you get all this activity and it'll have a quick whoosh to the downside, and people who are thinking about going short up here, they don't, and so what happens is finally it comes down here, they go short, then it starts going against them, kind of comes back down their way, they're like, yeah, go back down. But then all of a sudden it goes whoosh to the upside, and that's when they lose the money, okay? So what we're looking to do is take that short and then push it back down, and then the stop loss is back behind the 20-period moving average. Okay, so we have those cards. I want to draw those 5 names too, real quick. And again, if you use different strategies, Ichimoku Cloud, your other favorite trend strategies, whatever kind of strategies, you can use this very simple chart to help you determine trend in the way you like to determine your trend. And we're looking for spikes that start from above the 80 in an uptrend, fall below the 20, above the 80, below the 20. All right, can I collect those cards right now, guys? I want to draw those 5 names for you real quick. Yep. So, all right, let's bring them on up, guys. So this strategy went ahead, and it was very important to me. Now, I don't see Tariq in the audience right now, but he'll be with me this afternoon. But he was with me, trading against me in the competition. All right, you guys stay up here with me in case I need help with names. Can you pick 5? So if you guys don't win, if you're not one of the 5, it's his fault. Okay. Okay, give me 5. And if your name's in it, I'll be suspicious. All right, so everybody remember the guy in the yellow shirt. All right, okay. So so this helped me here, $3,250 US. Actually, it was a total of $4,837 over 18 trades in 6 hours during one of the trading competitions. And the $3,000 was using this strategy over and over again. It was a day where the U.S. market was going down, down, down very sharply. And so every time it popped back up, I shorted again. Okay, so, very good profits in a very short amount of time. I may need your help. Or would you come up? The lovely. So I think this is Xavier Cardenas. Well, she says that we're in trouble.
No, Xavier Codina. Ay, enhorabuena.
All right, Francisco Garriz.
Francisco Garriz. Fantástico, enhorabuena. Afortunado. María Teresa. María Teresa. María Teresa. ¡Ay! Allí, María Teresa.
Come on up, guys.
Fantastic.
Come on up.
Ah,
Daniel.
Daniel Middleman. ¿Daniel? Daniel, allí.
Okay.
Fantástico, enhorabuena también. Y Ricardo Freitas. ¿Puede ser Freitas? Ahí. Enhorabuena.
You guys can
Enhorabuena.
come over here. I'll give you those. Thank you.
Los 5 ganadores. Okay.
But everybody, I'll go ahead and invite to my live trading room next week. I'll send you an email. So in closing, gang, I use this strategy in my live trading competitions. I use it in my live trading room, as you'll see when I invite you next week. This is for real money. You know, this helped me win many of these real money competitions around the world. And I appreciate you guys being here. Thank you, Madrid. Thank you. Okay.